the business of the economy. No pressure, folks, no pressure. But you have to determine what is in our future. Okay? So we'll ask for quick introductions. And give us the worst case scenario where we're going to be by the summer. Wait, the summer? Now let's say the fall. Worst case scenario, economically speaking, let's just say, it's also geopolitically, of course. But what's the worst case scenario? What is the nightmare scenario where we'll be at the end of the year, just to put us in a great mood, okay? So Melissa, we're going to start. Melissa Isman is from Plymouth Rock Insurance Corporation. Then we'll have Elissa from Focus, New Jersey, and then Mike Griffin from JP Morgan Private Bank. So let's start. Let's go all the way to the end. No pressure, Melissa. You have to predict the future, the worst case scenario. But first, tell us what you do.
Is this working? We want to make sure I was on. Okay, good. Hi, I'm Melissa Isman. I'm with Plymouth Rock Assurance. I've been in the insurance industry longer than I'd like to admit, over 25 years. I've been with Plymouth Rock for about 5 years, so I work in the business development. So we look for partners to offer our products, which would be personal lines insurance, home, auto insurance, renters, condo, umbrella. And as Anthony said, we just recently partnered with the NJBIA. Worst case scenario by the summer?
Yeah, let's say the summer.
I don't get to take a vacation.
That is the best answer ever.
Ideally, I think for me, if we're talking kind of more of a little bit serious note, there's lots of talk about recession. I don't think that it's necessarily quite here yet, but I think rumors of it coming or pending, are definitely relevant and keep coming up more in conversation. So I think if we're moving further into that direction where it actually becomes something that is on its way or coming, that for me is worst case scenario, because that obviously then trickles down and has a lot of negative effects. And I won't be taking my vacation.
That will affect our vacations, absolutely. Okay, thank you, Melissa. Go ahead, Mike.
Hi, everyone. My name is Mike Griffin. I work for the JP Morgan Private Bank based out of Summit, New Jersey. My role, my fancy title is investment specialist. All that really means is my job is to work with large families, public company executives, private business owners, endowments, and foundations to help them build investment portfolios that accomplish their short, medium, and long-term goals. I've been at JP Morgan for 20 years, in the financial services industry for 23 years. So I've been through a couple of these rodeos over that period of time. And so from my perspective, thinking about what the worst case scenario looks like moving into the back half of the year, I would say very simply, it's if the tariffs as they are currently constructed, or close to how they are currently constructed, remain in place, then it is certainly not definite, but more probable than not that the economy will slip into a recession. And so that means all sorts of nasty things. That means more downside to equity markets. That means higher unemployment, and there are certainly knock-on effects for, irrespective of what one does for a living, there are knock-on effects for all of us. So that's how we're thinking about, what the worst case outcome could be here.
Got it, thank you. Elissa?
Good morning, everyone. It's hard to follow my two fabulous colleagues, but my name's Elissa Frank. In this context, I am Executive Director of Focus, New Jersey, which is an independent research arm of NJBIA, where we conduct research for workforce development and economic policy. I actually just started in this role in January, so I'm quite new, but I've been with the association as Vice President of Government Affairs for about 1.5 years now, covering labor and employment issues for the association, so they keep me quite busy. As far as what our worst case scenario is come this summer, I know my colleagues already touched on it, but there's obviously a lot of discussion about an impending recession. Specifically in the focus of Focus, we'll be looking to see whether or not unemployment rates go up, CPI index increasing as well. So there's a lot to be aware of.
For sure. All right, so most of it is beyond our control, but we can just respond, right? Agility is important here. Let's just build on what you mentioned about that. Obviously, tariffs are in the news. Is there anything you're watching for from a local or national perspective, or from your business perspective? I think insurance is, I'd be curious to get your take. Insurance is such a robust business, right? It's so stable, right? Even in the face of tariffs. But I'm just curious. Maybe I'm wrong.
No, absolutely. I think we're watching interest rates, wage growth, and obviously I think consumer confidence, that's a huge part of it. These factors, I think, will, ultimately directly impact insurance in general. It pertains to the affordability, auto and home sales, and I think just the overall demand for our products. So those are definitely things that we're trying to keep an eye on as we're moving through the changes that are possibly coming our way.
I think maybe to play off that a little bit, I'd say at a high level, one of the things that we're watching closely is how what we're seeing in what we call the soft data starts to migrate into what we call the hard data. So what do I mean by that? So when we refer to soft data, so think about surveys, right? Consumer sentiment surveys. People from different organizations make a bunch of phone calls, send out a bunch of communications. This happens systematically every month. There are a number of organizations that do this. A very prominent one, for example, is the University of Michigan. They ask people how they're feeling, right? How are they feeling about their employment prospects? How are they feeling about job opportunities, things of that nature. And so that could vary wildly from month to month, depending upon what's going on in the economy and what's going on in the world. Not surprisingly, the readings over the past couple of months have been decidedly negative. Now, what people say and what people do are two very different things. And so that's why what some of the deterioration in the soft data that we've seen, while notable, hasn't necessarily translated into the hard data deteriorating. So what do I mean? Durable goods purchases, people making plans to go on vacations. There's some anecdotal evidence that that's beginning to slip a little bit, but we haven't seen it in such a way that it's alarming yet. And one of the reasons why we're watching it is because of the fact that there's a lag. So there typically is a lag of, depending upon who you ask, which economist you ask, 3 to 6 months between deterioration in the soft data migrating into the hard data. So we're very focused on watching that transition to see if it does in fact unfold. And then sort of that's at a general level, and more specifically, as it relates to the consumer, as Melissa noted, look, the consumer is responsible for 2/3 of economic growth in this country. As the consumer goes, the economy goes. And so specifically, if the labor market does in fact deteriorate, and that, by the way, we haven't seen that yet at all, right? That hasn't shown itself in the data. We'll get an employment report this Friday, so that'll be more telling. But again, focusing very specifically on the consumer and whether or not they continue to spend or they become more cautious is really going to have a material effect on whether or not the economy avoids recession or slips into one.
Okay, great.
Yeah, and similarly, we're closely monitoring a mix of real-time and lagging indicators across both macroeconomic and sector-specific levels. On the macro front, we're paying particular attention to shifts in business investment, industrial production, and export volumes, especially in manufacturing-heavy regions. We're also watching for signs of pass-through inflation in both consumer prices and input costs, which can signal supply chain disruptions or pricing power constraints. Also, on a more granular level, we're tracking corporate earnings guidance, particularly in sectors like agriculture, technology, and consumer goods, as well as anecdotal data from supply chain managers and small businesses. All in, these provide an early view in how firms are adapting or struggling in response to the changing trade environment.
Okay. Should we go buy toilet paper? I did hear something of that in the news. Did you
Paper
guys hear
towels.
that? Is that, we've been through a pandemic, so we're a bit more agile and resilient, resourceful, but is there anything we should do? Again, I know you guys know the future. Anything we should do?
I think that, for when we just talk about insurance, there's things that you can already be doing, right? If you're looking to kind of make sure that your costs are within your budget. There are And I'll just use one example, and this is a big proponent I'm a huge fan of is our telematics program. A lot of insurance companies provide these telematics, and they're data-driven based off of individual driving habits, right? So a lot of people don't like to use it because Big Brother is watching, but my insurance is high. Well, you may live in an area that you're, in a high loss ratio. So unfortunately, insurance is a pool of risks. So those other drivers affect your premiums. But this gives you an opportunity to shine and show us that you individually are a good driver based on certain components. So staying kind of ahead and being able to save that money and pocket it, you can save up to an additional 30% if you participate in certain types of programs.
Okay.
So, I think just kind of being proactive versus reactive to things, and, if there are things that are available that, are technology driven and, all the data that we have now being useful, are taking those things and putting them to good use now versus waiting, now I can't afford my insurance, let me do it. Like, let me just take advantage of those things now and be educated with them.
You touched upon something I think that's very relevant, and while you and I do things that are slightly different day to day, to a certain extent, we're both in the risk management industry.
Right.
And so from my perspective, the risks that I'm trying to help my clients manage are making sure that we address any concerns they have as to whether or not their portfolios are going to continue to help them meet their goals, right? And so part of that process is recognizing the fact that whether one is investing just for income to sustain themselves through retirement, or one has utilized trusts for planning for children that aren't even born yet. They're two very different goals. But at times like these, when uncertainty is particularly elevated, and right now, candidly, policy uncertainty by some measures is at the highest it's ever been recorded, it's really helping folks understand the risk to their portfolios, irrespective of how conservative or aggressive they are, and making sure that they're comfortable with it. And if I've done my job, we've prepared for environments like this. The cause of recessions is often different. But we know that there are certain things that are common to all of them in terms of how equity markets are going to perform, how bond markets are likely to perform, and so preparing clients for all of those likely outcomes at some period of time developing is an important thing.
So regarding that, have you been doing a lot of hand-holding in the past month or so? Is that
more hand-holding than anything, and it's challenging because sometimes I think all of us, our natural inclination when that much uncertainty is introduced into our lives is to say, all right, well, what do? We should do something. The candid truth is, for many folks, the answer is probably not to do anything, and really bringing it back to the plan that we've worked hard in less volatile times to put in place to make sure that we could navigate the uncertain times that are bound to unfold at some point in time. So much more hand-holding than anything else.
I think that education piece is so important, right? It's not necessarily needing to be an expert, but having a one-on-one and understanding your own unique needs and what those look like and how those possibly can be effective for you individually. And like I said, trying to stay ahead of that curve, and if it means doing nothing, but having those touch points that you have that person or professional to check in with.
Yeah, I'm obviously not in the business of risk, unfortunately, but I could speak from a policy perspective. I hate to give this answer, and I'm sure you've heard it so many times and time again, but we kind of have to wait and see what's going to happen, right? We're getting this job report on Friday. We're going to see some of these beginning numbers in that job report, but we have to see how the market is going to react. What's going to be in this job report? Are we going to see higher unemployment, a higher CPI? Likely, yes, but we have to see what's going to happen and react, intelligently.
Yeah, for sure. We can try, right? We just do the best we can. But, we will be affected. Tourism, right? I mean, we get a lot of tourists. We don't realize it because we're from here, at least. But that could have a significant economic impact. Are you tracking that, Elissa?
Yes, absolutely. We've been hearing from members, particularly those who operate hotels in Cape May County. Surprisingly, they actually receive a lot of their tourism industry. It's actually from Canada. and they have already seen a reduction in bookings, so much so that they were reaching out to some of our colleagues, and maybe this benefits us at NJBIA, asking if we want to book and go down to Cape May for the summer, which maybe I should do that. But they have, in all seriousness, they have seen a reduction in those bookings because Canadians don't really want to come here and vacation, and there's a lot of uncertainty about what would happen to them if they were to do so.
Yeah. And also, again, as we know, there is a lot of manufacturing in this state. We don't realize it, but as we learned earlier, international paper, tariffs are going to affect our exporters, our manufacturers, among other things, right? So there's unintended consequences and realities. So any other thoughts as far as, businesses, what should businesses do to sort of somehow plan, because everything is changing on a weekly basis or daily basis. Is there any tips that you are giving your, businesses in general, Mike?
Well, I think what folks, whether they are public company executives or private business owners or folks that are managing businesses are likely to do is they're likely to adopt just a more conservative stance over the next several months, right? And we're seeing that across corporate America. What companies aren't doing yet broadly are, announcing widespread layoffs or any sort of restructurings that may entail taking a view out longer than 12 months. What they are doing is they are coming out to to Wall Street and saying, look, we provided an estimate of what we thought we could earn this year. We're going to put that on hold, right? We're withdrawing that estimate, and that doesn't necessarily mean things are going to get dramatically worse, but I think it speaks to the fact that for now, folks are opting to stay conservative. So I think all of our expectations should be that irrespective of how large a company is and what industry they're in, the near-term outlook is going to be one where folks will take more conservative positions.
Okay. Any questions? Let me make sure that we end right in the back there.
Hey everyone, John Luca from NJBIA in Focus, New Jersey. I'm currently a research assistant and I work with Elissa up there. So my question is sort of for you, and you spoke about unemployment and that possibly being like a lagging indicator. It will probably go up based on our knowledge of what will happen with tariffs and general economic indicators, but would you be able to speak on structurally, like how different industries may be impacted, and there may be some positives that we can look at during maybe like a more gloomy time? I know we've looked at a lot of industries together on a more workforce development side of things. So how can we sort of, go about it at that angle?
That was for me, John Luca? Okay, just making sure. So, one thing that's important to note is as far as unemployment numbers are concerned, we haven't seen the numbers reflecting the mass layoffs in the federal government yet. We should start to see some of those on Friday with this jobs report. As far as industry-specific issues that we've noticed, we have felt the effects of unemployment or the tariff policy specifically in manufacturing, where a lot of our manufacturing members have spoken to concerns that they are receiving grant money from the federal government, which has been either paused or suspended altogether. And they have folks who are working on the projects that are funded by the grant money and they can't pay them. And so it's hard to proceed in that regard when there's so much uncertainty as far as doing their budgets, doing their employment outlook. So we're hopeful that at least for the state budget, from the state budget perspective, we're asking the governor to restore funding to NJMEP as well as for manufacturing-focused industries to provide some of that more state support.
Was one of the questions if there's been any positives from the tariffs, I think? Was that a question he had?
Do you see any positives? No.
Ironically enough, Michelle and I had a conversation this morning regarding Temu, and I guess Temu just had its first additional charge. You know, typically you can get something for $4 or $5 off of there, and now there was a $28 additional charge. And you know, for Temu, that's not necessarily great, but now that pushes back to buying goods here in the United States, right? So that $5 dress now I'm going to pay more where I can buy it in the States, and let's just say it's $40. So I think in hindsight, that's great. It brings more business to the business owners here. But then it's kind of okay. Well, if we're going into recession and I don't have the additional money to buy that $40 dress now, it trickles down. So there's a pro and there may be a con attached to it. So we're quite not sure yet.
For sure. Any other questions? Any other questions?
Hi, this is Suezna. As a New Jersey resident, obviously most of us have Roth IRAs for our retirement, and a recession coming. What to be careful about in regards to investing when we are managing our Roth IRAs?
Great question. So I'll answer that in two ways. Number one, from a investment vehicle perspective, right? A Roth IRA is an ideal savings tool for retirement, right? Because those, as opposed to a traditional IRA, when you're required to take a distribution from that, those distributions are taxed, right? You have to pick that up as ordinary income. With a Roth IRA, you face no such hurdle. So it is a great vehicle, and I encourage everyone that I work with, irrespective of your level of wealth, to contribute to Roth IRAs wherever you can. As it relates to the markets, let's talk about the reality of what recessions mean for markets for a moment, right? Every recession is different. Some are what I'd characterize as garden variety, where you don't necessarily have things that we experienced during, let's say, the 2008 global financial crisis, where you have a wave of bank failures, where you have unemployment reaching double digits and things of that nature. But even a garden variety recession is going to be painful, right? People are going to lose their jobs. Consumers are going to have to pare back. On average, what we experience in a recession, or what folks should expect, is, let's say, the market, i.e. the S&P 500, right? So the largest 500 or so companies in the United States are going to decline, on average, in a recession, peak to trough, by about 30%, right? And so that's not going to feel great. So I tend to advise my clients that when everyone loves to have an idea of like, all right, well, like, Mike, can you quantify what's going to happen? Well, not exactly, but I will say that should be within the realm of expectations, right? In more severe recessions and economic crises, in 2008, the S&P 500 peak to trough, from the peak in the fall of 2007 to the trough in March of 2009, the S&P 500 declined by 57%. Now, that was statistically a sort of a once in 80 to 100 year event, right? But that's what folks should expect. And so the advice I tend to give in those situations is to make sure, and this is the most critical component in some respects of what I do, to make sure you're invested in such a way that you can ride those out. And for what that means for a lot of folks is to make sure that they don't have too much equity risk, too much exposure to stocks in their portfolio, because the worst thing one can do is liquidate their equity positions in the midst of or towards the end of one of those drawdowns. And I get it, it's hard. I may do this professionally, I'm still a person. I don't derive any satisfaction from going into work those days where it's really painful and all you see is red on the screen. I recognize it's difficult, but I'll give everyone just a quick example, and I don't mean to hog the mic here, but I do think it's relevant for all of us. In March of 2020, particularly sort of March 17th or 18th, I had a client that they had invested in, they had money in trusts. These trusts had been invested for 40 years in 100% equity portfolios. Several days prior to this conversation, we sort of talked about the state of the world to the extent we knew anything. They seemed to be comfortable, and then very quickly they were not. They were no longer comfortable. And so they decided to liquidate their entire equity portfolio. They knew the risks associated with doing so, but they were concerned about bigger things. They couldn't take it anymore. The bottom in the market was 5 days later. These folks did not reinvest in equities until December. That's permanent wealth destruction. They will never make that back. And so my advice to my clients and the advice that I'd give to my family members is, look, the more important thing to do is to spend the time, hopefully before a crisis unfolds, making sure that you have a level of equity risk in your portfolio, whether it's a taxable portfolio or a Roth IRA, that when these times inevitably come, you can sleep at night. It's tough, but that is the most important goal. So that would be the specific advice that I would share.
Okay. Any other questions? I think we're coming to the end of this panel. Any other questions? All right. Well, thank you for your forecast. We're going to move on to the next panel.
Thank you.
Thank you for having us.